Hello and welcome to traders and investors, and I'm glad to present you the daily market review prepared by analysts and experts from fx.co portal. Here we go. And we're starting with EURUSD as usual. Let's discuss the trading plan with Miroslav Bavulski. News that Iran attacked commercial vessels and reportedly seized at least 2 ships in the Strait of Hormuz strengthened the US dollar and escalated the conflict further. The next move in EURUSD will depend on Eurozone PMI data, manufacturing, services, and the composite index. Expectations are weak, which could increase pressure on the euro. In case of a decline, the key support to watch is 1.1682. A false breakout there would provide a long entry, targeting a recovery to 1723. A breakout and retest of this level would confirm bullish momentum, opening the way toward 1.1762, which could halt the bearish trend. The final upside target is 1.1791, where you could take profit. If EURUSD continues to fall and shows no buying interest around 1682, downside pressure will likely intensify. In that case, sellers may push the pair towards 1651. Only a false breakout there would justify long positions. Alternatively, we would consider buying on a rebound from 1619, targeting an intraday move of 30-35 pips. Bears remain in control of the market. If the pair moves slightly higher after the PMI data, sellers will focus on defending the 1.1723. A false breakout there would provide a short entry, targeting a move down to 1.1682. A breakout and consolidation below this level, followed by a retest from below, would open the way for a deeper sell-off towards 1651. The final downside target stands at 1619, where you would take profit. If EURUSD moves higher and bears show no activity around 1723, where the moving average favors sellers, the euro may stage a stronger recovery. In that case, it's better to postpone shorts until the next resistance at 1762. We would only consider selling there after a failed breakout. Alternatively, you could plan to open short positions on the rebound from 1791, targeting a 30-35 pip downward correction. And now it's time for GBPUSD. Let's discuss it with Paulo Greco. The average volatility of the GBPUSD pair of the last 5 trading days is 72 pips. For the pound-dollar pair, this value is considered as average. On Thursday, April 23, we expect movement within the range limited by the levels of 1.3434 and 35.72. The upper channel of the linear regression is directed downward, indicating a downward trend. The CCI technical indicator entered the overbought territory and formed a bearish divergence, warning of a downward pullback. The GBPUSD currency pair continues to recover after 2 months of geopolitics. Trump's policies will continue to exert pressure on the US economy, so we do not expect the US currency to grow in 2026. Thus, long positions with a target of 1.3916 and above remain relevant as long as the price is above the moving average line. It's a sign line on the graphic. If the price stays below moving average line, short positions can be considered with targets at 1.3428 and 33.67, pure on technical grounds. In recent weeks, the British currency has recovered, and the influence of geopolitics on the market is diminishing. That's all for today. See you online soon.